Welcome to Market Radar. We're not investment advisors, security analysts, or brokers. The following information is strictly for entertainment and educational purposes only. None of the information here is intended as a buy or sell recommendation. Welcome to another Market Radar podcast. It's May 21st, 2022. Let's get started with the year-to-date performances. So, S&P down 17.97%. NASDAQ down 27.44%. Jeez, it keeps getting worse. Russell down 20.85%. Dow Jones down 14.01%. Our everything is still in bearish trend on DDAP. Our regime model is now at a 76.6% chance of risk off. So that's stagflation odds plus deflation odds. That's pretty high. It's pretty high confidence on our system that we are in stagflation, which we are, and it's been a while. Let's go through the economic calendar. Monday, we've got no market moving events. Tuesday, we've got PMI composite flash, new home sales. That's it. Wednesday, we've got durable goods orders, EIA petroleum status report, and FOMC minutes. Thursday, we've got GDP, jobless claims, pending home sales index, EIA natural gas report, and Fed balance sheet. Friday, we've got international trade in goods, personal income and outlays, and consumer sentiment. Let's take a look at what ES did this week. So we had that little bull trap over there the end of last week and continued early into this week, and then sold off. Friday, pretty crazy day. People are calling market bottom from that. Basically just had a rip into the close after a massive sell-off. And you know what? It could lead to a bear market rally. We could see a bear market rally up to the upper vamp. Momo, probably not. That's a bit of a stretch. But upper vamp, definitely possible. So if you're into it, could be a good short entry at the upper vamp. But that's not what we do. We're more long-term traders. We trade the big moves, but it's if you've got DDAP, it can help you. You could sell premium at that level or flat out short if that's your thing. Let's look at ZN. So ZN, we are getting a little bit of a bottoming action here. As we said last week, it's possible that ZN chops around here for a while. That is typical for what happens after such a large move in rates like this. It's gonna chop a bit, and we're hoping to see Momo catch up as it chops down in this range here and get our exit, or sorry, not exit, or get our TLT TMF bond play when it passes Momo. So that's what we're setting up for. That's going to be the big move. Everything else before that is just a bull trap, so be careful. So today we want to talk about timing market cycles. So, it's not easy. It's not like a flip of a switch, right? The economy is a very vast thing. There's so many moving parts to it, and it's not always a clear switch on to the next regime. So we got to figure out, what happens as we go into another regime. What are you supposed to look out for? So we're going to talk about that this podcast, but first, let's talk about rates.
Okay, so let's talk about before we get into rates. Let's take a quick look at what the interest rate probabilities are of the federal funds futures. So or federal funds rate hikes, I should say. What's the probability and where are we going with that? So we are still expected to see 7.5 rate hikes into December's 2022 meeting, right? So 7.5 rate hikes of 25 basis points each. Do I think we get there? Don't know yet, but we had Powell come out today, or not today, I'm sorry, last week, and he basically said that restoring price stability is an unconditional need, right? So he's basically saying, he's basically telling you that he's going to do what he has to do to bring back the normalization of prices and stable out the economy, which obviously with inflation you're seeing things continue to rise, such as gasoline in the last 2 weeks hitting all-time highs. And we also saw um, this week we had the Philadelphia, let's see, the Philadelphia Manufacturing Index come out, and it's at a reading of 2.6. This is the lowest reading since the 2020 COVID recovery rally prior to us, breaking past those S&P all-time highs after we had that crash. So we are heading towards zero and possibly negative territory. Obviously, this is not something good. This is not like what you want to see in the bottom or the end of a cycle. If we go back to our regime chart, right, we've been saying this, we've made this very vocal that we are here. We are not here. We are not here. We are not here. We are here.
Yeah, we are at
What is
the tippy top of
right?
stagflation rolling into deflation.
And what do we call that? We call that peak late cycle. So this is peak. This is peak. This is bottom, right? So this is peak. I mean, simply put, we are roller coaster top heading for the downturn, right? We're not there yet though. We haven't actually seen the effects of deflation materialize in commodities and other goods and services. So as we talk about commodities, let's go into the this is not global. This is the top 10 oil producing countries. So this is the top 10 of I should say this is the oil production of the top 10 countries, overlaid with, in the orange line, GDP. So the blue line is oil production of the top 10 countries, and the orange line is the United States GDP. So what is this showing us? Real simple. Oil production has yet to summit its prior peak. So we haven't been able to recover with what we would call global oil production, at least on the of the top 10 countries have yet to reach pre-COVID producing levels. Now, what is this showing us in the terms of what you're seeing today? So you see GDP, right? GDP, the orange line. We obviously took out the prior COVID highs or 2019 highs back in late 2020. Right into 2021, we broke those highs. GDP recovered from its whole COVID stint.
So
Well,
this kind of looks like a textbook example of demand continuing to increase while supply is lagging behind, driving
right,
prices higher.
right, right. And that's something that is quite apparent, right? So GDP has been able to basically put the floor in and accelerate. Oil production hasn't. So while the economy, quote unquote, was coming into recovery, the concept of sticky inflation remain, where the supply chains and access to those materials have not been repaired. So
Oh,
this is
something to keep in mind too. Russia is in this top 10 oil producing countries. So,
yeah, you can only imagine now with that whole
yeah,
again,
so
it
that
just keeps this thing, excuse my language, but this thing will just keep getting fucked up. Like I
yeah,
don't see how this
it's not getting better anytime soon, that's for sure.
right. So let's go and let's take a step back from what this is, right? So let's look at the big picture here. We have what we call sticky inflation, and on the curve here of the cycles, we are looking for what's next, and that's deflation. So when you're looking at a perspective of market cycles, what you need to pay attention to is the entire slope of the curve and where you're going. Because if, let's just say we were in expansion, right? And we are like, okay, we want to position ourselves to take advantage of what's here and what's going to come. Well, odds are inflation is going to come next. This is not, by the way, 100%. It's not like, oh, you're in expansion, inflation is definitely coming next, then it's definitely stagflation, then it's definitely deflation. These things can kind of skip one. It's very, very rare you go from expansion to deflation or from deflation to inflation, where you're skipping a whole like regime in the middle. Not to say that it won't happen, but we prepare for the highest probable outcomes, right? So if we're in expansion, we're likely saying, okay, what's next is most likely going to be inflation. So the risk on trade kind of gets pushed forward and gets extended. Whereas we're here in the cycle and the risk off trade will likely get extended as well. So, what I mean by that is let's just take a look at ES. And this is ES back in 2008, the great financial crisis, back in from starting in 2007 all the way down to the just about the end of 2009. So, as you can see here, we have the DDAP script enabled with ES. And back in early 2000 or mid 2007, mid to late 2007, ES goes bearish trend. And this again is a warning sign when a major index like the S&P 500 or S&P 500 mini futures, right? When they go bearish trend, it's like, okay, it's a warning sign. Then they go bullish trend, right? And this is where integrating two pieces of the system or two pieces of a model is very important, right? Our model is not just a system, our system or DDAP, or I should say our process, right? Not our model. Let me correct myself. Our process is not just the system or DDAP. It's combining the system and DDAP together because while back in late 2007, ES or S&P is going bullish trend, a lot of people, by just looking at a specific facet of the entire the entire process being DDAP, you would say, oh, everything's okay, right? And then when it goes bearish trend, you're like, oh man, I lost money, I got faked out, right? Those that look at the at DDAP would say this is a fake out, right? But if you combine the system with DDAP, you would know that this was all risk off, right? So while the S&P went bullish trend, you were basically being warned by the system that it's most likely going to be a fake out. And this goes back to our conversation on bonds, right? So if we go back to bonds here, could bonds rally? Yes, but the odds of them being a fake rally are very high, given the fact that we're not in a regime to basically give them the most odds of success or the highest odds of success. So for that being, we don't like the bond trade as of right now, right?
Yeah. We need
We
deflation for that, and we're actually
right,
pretty far from deflation. We're in
right.
like inflation is not peaking. That's the bet that everyone's trying to make right now is inflation peaking.
Right,
But
and as you can see, I mean, I don't mean to interrupt you, but look at the system strength.
yeah, look at the system strength. Like there
92%.
that doesn't happen easily, you know? Like you get a system strength like that in stagflation when inflationary products are insanely high, and
Right.
they are, you know, like
Yeah.
look at oil, look at corn, two large outperformers in stagflation, and they're still vastly outperforming. They're not slowing down. So deflation could still be quite a ways away.
Yeah. Now, that's not to say like if deflation comes on Monday, are we confused? No. We expect deflation to be here at some point. When it happens, if I told you exactly when, well, I wouldn't be making a podcast right now. I'd be hunting out of the money options like a psychopath. Okay? If I knew that the exact time that it would happen. What I can tell you is it's the most probable upcoming event, right? I don't know when though.
Yeah.
So let's go and talk about shitcoin first. I mean Bitcoin. I'm sorry. Hold on. Um,
Was it
This
60% down from the
yeah,
peak?
yeah. Let's do a quick measurement on here. Now this is not a Peter Schiff podcast. We actually do like Bitcoin. It's we like crypto. It's down
There's a time and
57.4.
place.
There's a time and place. Yeah, there's a time and place for everything. This is down about 57% from the highs, and I believe around here, mid-April, we were telling, you'll see a tweet coming up next week about it. We were basically alluding that 2021 lows were possible, and we got exactly that. Now, why? You may ask. Well, real simple. We are in a risk-off regime, and Bitcoin is a risk-on asset. So, one plus -1 is 0. No bueno. You don't want to own Bitcoin, right? You want to own risk correlated regimes to the assets in which you're, risk assets in risk on regimes that are correlated risk on, right? So risk off assets that are correlated risk off and risk off regimes, meaning risk off assets are things like dollars, bonds, depending commodities, but those are real iffy. And when what type of regime you're in, obviously they're only good in stagflation. Um, and and obviously all of them put together, um, you want a cash-based portfolio, not just owning dollars, but you want a negative beta or short base portfolio in a risk-off regime. And Bitcoin is not something that you want exposure to, simply put, right? So um, this is not something that we intend to buy at any point. And I know there's a lot of talk out there that Bitcoin at 20K, I gotta load the lows to 20K, or Bitcoin at 15K is the buy, or some people, a barber, and your barber probably asks you too, what do you think about Bitcoin? If you know anything about finance, he's gonna ask you that. Well, at least he asks me that, and I tell him that I don't know because I don't know when it bottoms. I don't know when we got a risk on regime because that's how we work, right? We don't look for bottoms, we look for the pivots in the regime cycle. So once the pivot comes, it could be Bitcoin 20K, Bitcoin 15K, Bitcoin 10K. And there's a lot of people that say like, oh, Bitcoin's not going to go to 10K. Well, I mean, again, if how you know that, I don't know because I don't know that. I know a lot of
It very well could.
right. I know a lot of things when it comes to like market pricing and timing and and understanding volatility. And if you understand Bitcoin's um, asset class volatility, right? That's correlated like the volatility of its specifically associated to Bitcoin, you can very well understand that it can be 10,000, right? I mean,
Yeah. Well,
Bitcoin's had 80.
something that's actually very interesting is this dip, or this I guess it's more than dip now. This market sell off is different than other market sell offs because you're seeing you're seeing a sell off in almost every asset
Yeah,
class.
I
Like,
think
you got
that's a good point.
watches coming down. You've got I heard even shoes. I'm not big into shoes or anything, but apparently there's a shoe bubble. I didn't even know about that, but apparently shoe prices as well, like designer shoes. Like it
Yeah.
seems like every bubble is popping. And so
Well,
that's kind of something
that's a
that
good point.
separates this sell off from the usual sell off that we see.
Yeah, and I think that goes back to the lies that everyone thinks that the consumer is strong, right? That's the whole pitch to everyone. The consumer is strong, and I think the best way to do that would be probably like Home Depot, right? Like the consumer is obviously not. You know what? Even better, Amazon.
Well,
The consumer is
look
not
at
strong.
Walmart too.
Yeah, Walmart. The consumer is not. Oh, I mean, the thing about Walmart is they have like they're more of a staple, right? Because um just the demographic that they serve. I don't want to get into it, but they're more of considered a staple than something like Amazon, right? Amazon's more discretionary.
Okay.
Um and you can just see like dude, like this thing is we're basically getting back to, pre-COVID
To
pre-COVID
normal
highs.
levels, essentially.
Yeah, like this thing's getting destroyed, and it just goes back to um, the problems of the problems of which the consumer is in at this moment, right? We got credit cards hitting like credit card debt hitting all time highs. We have people that are suffering from inflation because like let's just run a quick scenario. Let's just say you go food shopping and you're a very meticulous person. I'm an individual myself that likes routines, right? So I like to do things in routines. So if I go to the food store, I know that I need this, and that, right? Like it's usually the same things over and over again. So it's like maybe like 2 boxes of cereal, 4 boxes of pasta, etc., right? You have consumers doing the same things over and over that have a fixed wage, right? Like let's call it, depending where they work. Let's just say if the median United States income, I believe, is like 30,000, right? So let's just average it out to 36, and let's say make $3,000 a month. Um, what's that, like 700 it's between $700 and $800 a week, right? Um, they have that $700 to $800 a week fixed income. Now, the grocery bill is not fixed, but they might buy the um, same consecutive items on a weekly, or the same items consecutively on a weekly basis, where they are realizing they're spending more and more money, but they're not making it. So it's like the same and most people buy enough food to last them a week or two. They're not hoarders, and they're not, discount. They're not buying in bulk. So they buy these things and they realize that like they are not going to cut back on them because a lot of those things are necessities, which we spoke about. And I think it was 2 podcasts ago about the sticky aspect of inflation, right? Being goods and materials that you need to survive, right? Like a watch, you don't need to survive. It's usually the risky assets or the things that are non-essential that see the pain first. The riskiest assets are those that are non-essential, I mean to say. So you go to the store, right, the grocery store, and you're buying the same 4 or 5, or call it 15 items, and those 15 items are getting more and more expensive over time. Or for some, unfortunately, for some cases, you can't even find them in the case of baby formula, right? But let's just say those costs keep going up, and the consumer only makes that much money a week, and they have to pay rents, which are also rising. They have to pay utility bills, which are also rising, right? All these things that are rising, so they realize that they have to tap into their credit cards. And the media, or I should say, Wall Street's portraying Main Street to be a strong consumer, strong, right? Unemployment, right? Let's say unemployment's at lows. Well, just because unemployment's at lows doesn't mean people are necessarily not struggling to meet ends meet, right?
Yeah,
And
and I've
this,
actually noticed that quite a bit. People saying on Twitter like, "Oh, the consumer is strong. Buy the dip."
yeah,
You know,
yeah, yeah, I know, and that's the thing that everyone wants to talk about.
but
It's because
you have to ignore so many things to really
I
believe
know,
that.
I know, and the problem is this goes back to our podcast last week about the melt up. I Unfortunately, I think a lot of people from an index perspective need the melt up. I mean, like just look at it on the S&P, right? We're down 18% year to date. 18.05% year to date on the S&P 500, right? So think about that. The S&P is down 18% year to date. All the fund managers are underwater, right? If you tell people the consumer is weak, people are gonna get scared and want to liquidate. Everyone's been trained for years to buy. When I say years, I am talking since 2016, right? Between 14 and 16, the market really didn't do anything. Then Trump came to office and he basically unloaded a lot of things of financial regulations and whatnot, and growth, like, new businesses and all these things started accelerating. Was it all Trump's doing? No. Obviously, the Federal Reserve has been at the heels of this market since the end of 2008, the GFC. Basically, with QE in 2018, we saw how that went, where they wanted to curb QE, and the market took the shitter and do some QT. Then they went back to basically QE. Now we're here. We're back to QT. Problem is there's no reason to back off QT. As you heard me at the beginning say, that Powell says he will basically do anything to get back price stability. Inflation is too high.
So
And
let's talk about the main topic of this podcast. So
right.
timing regimes. So we're expecting deflation, right?
Right.
When do you think that happens? Like, is it so we have price inflation,
Well,
we have
right.
people struggling, and eventually it's going to get to the point where the consumer can't afford things anymore,
Yes. Yes.
right?
Yes.
And
And
that's when you
yeah.
start getting deflation, right?
Yeah. Well, let me always, I always like to preface everything in this podcast on our with whatever we do. We will not predict a regime before it happens, right? I will not tell you that you'll never hear me say it or us ever say that we're in stagflation and we're gonna get deflation next week. We'll tell you that the odds of deflation, as in here, are rising and it may take over, but there is no definitive. What I mean by that is obviously there is a number set here that we look at that it gives us a definitive answer, right? But there's not like I can't give you a timeline of 3 weeks, 6 months, a year, right? Or 2 weeks. That's like a forecasting ideology, and that's usually where people run into a muck where they get people all bulled or bared up for something that never actually happens. We're going to talk about something when it actually happens because that's when it's material and it makes sense to execute, right? So what you're saying is the consumer is eventually going to be weak and or the consumer is eventually going to break, right? They're already weak, obviously. They're going to break. That's true. But you'd be surprised that the consumer can break and the inflation can still remain sticky for a while because um, it, everything is like everything is lagged out, right? It's all layers of layers and layers into the economy that need to bleed out like from the top down to the bottom for you to see the results. So the consumer is already weak. Obviously, you can see that inflation isn't really abating just yet. I mean, gas prices are just hitting a new all-time high, and this goes back to diesel being elevated, right? So let's go over that real quick. Why does diesel matter? I actually had a conversation with someone earlier today about the effects of diesel in the economy. So, food, um, products, gas, anything that to be consumed has to be transported requires most likely diesel.
Well, yeah, like
Because
even farming equipment, right?
right. So if the price of diesel is elevated, right, it affects the price of food because the shipping costs inherently, shippers are not going to make no money and they are going to have to hike prices. And the first, I mean, it's a logical answer, a logical question I got today was, um, are oil prices or gas prices elevated because the companies are greedy? Well, this goes back to if you've ever seen ExxonMobil, um, their profit margins. I will try and pull that up as we talk. ExxonMobil's profit margins have basically been the same or in the same area for since like 1980 85 84, I believe. I'm trying to pull it up right now here. Let's see.
So that essentially debunks the whole Biden administration price gouging oil company theory.
Yeah, that's really what it does. Unfortunately, I'm gonna try and pull it up. Yeah, here it is. Okay, here it is. So let's look at this. And let's look at it on a quarterly basis. Okay, and let's look at it over. Oops. Let's look at it over. Can we do 40 quarters? Okay. Yeah. Okay. So this is their profit margin on a quarterly basis. So the last profit margin for quarter one 2022 was 6.24%. Actually came down, right?
Yeah.
That's their net profit margin. That's their bottom line. Like let's look at this going on on an annual basis, 40 years, right? So it's a their net income margin for 2021 was 8.32%. Well, for 2022, we're already at 6. We're already lower than this.
It's literally
I,
barely changed over the last 40 years.
I would say in 2006, going into the great financial crisis, they had profit margins of 11%, meaning they were making more money bottom line than they are now.
Yeah. So that whole price gouging thing, that's all bullshit, essentially.
Yeah. That's all. That's
They're
all. It's a crock of shit.
the real thing is they don't know how to fix inflation, and they're using this as an excuse. That's
Right.
that's that's what I'm thinking.
And just remember, um, these oil companies, they work in the refinement of the gasoline as well, right? So they have to refine the gasoline um, to a consumption level. Now they may wholesale that out and buy, like they may buy the gasoline, wholesale it out to a refiner and get that gasoline, whatever their process might be. Long story short, they have to use materials. They're not just buying gasoline on the open market, and this is where the problem comes in. This is not just gasoline. This is all other products, right? Let's just say you have a mill, right? And let's just say you have a mill that needs gasoline and you produce sweatshirts. Okay. Um, and let's just say that the price of gasoline goes down, right? But as the price of gasoline goes down, the cost of the materials to make the sweater remain elevated, right? Someone that looks at this scenario may say, well, the gasoline prices are going down, so your sweatshirt should be cheaper. But they don't realize that the thread to make the sweatshirt may be elevated, or maybe still elevated or going higher. And this is the same concept in the gasoline industry, right? Because they have materials that they need to refine, right? Which are a secondary component to the price of gasoline. Yes, you understand what I'm saying? Like they can
Yeah.
fluctuate differently.
Yeah.
And on top of that, we have the problem with diesel of actually transporting the finalized product, which is across every industry. They're having this issue where we cannot transport anything. Because I should say the cost of transporting anything is not going down. So how can you offset the lower prices to consumers if the price to transport them remain high and going higher? And this is the problem that we have with sticky inflation. Now, let's take a look at VIX and volatility. And I think this is going to be a great chart because we talk about this. I make it a point to talk about this every single day on Twitter. I talk about the VIX front and back month spreads and the whole term structure of volatility. So, what am I showing you right here? Well, long story short, it's two different things. The top, the blue one, is the VIX spreads. What the VIX spreads are, dumbed down, is where the market's pricing volatility to be in the mid to short term future. Actually, I don't. It's hard to say this, but where volatility is being priced within the next 2 months, the next 1 and 2 months. That's what this is pricing in. So volatility prices of the active VIX contract and the one following. Now, the term structure involves a lot more, many more subsequent dates going all the way out to the end of the year, where you could see, okay, you know, June, July, August, September, October, November, December. Where is the prices along the curve? You can kind of gauge what's going on via backwardation or contango, right? That gives us our clarification. If we look at a VIX term structure that I post every day, you'll see that over time, what's the consensus? Is it contango or is it backwardation? Well, what I'm showing you in the blue line here simply is the short-term consensus of backwardation to contango. If it is negative, it is showing you that volatility is getting a bid on the front month, meaning people are aggressively buying protection, right? They're fearful. And if it's positive, they're more complacent, meaning volatility is rising as you go out in expiration, or in time, meaning next month's vol futures are lower than the following month's vol futures, indicating that there's no demand for volatility. If we look at the oil curve, oil is going to be in backwardation, where the front month is always more expensive. I believe we can pull that up in one of these charts real quick. So if we go look at this, as you can see here, this is backwardation, where every month that goes out, it's telling you that oil is going to go lower and lower and lower.
Okay. So that's
Right?
the market pricing in that
cheaper and cheaper prices. Yes.
So basically, the market's thinking that inflation's topping, right?
Yeah, but the problem is
But I
with
mean, that's
oil
a
is there.
long time frame, right?
Yeah, I mean, like look, this goes all the way back to 2028.
Yeah,
You know what I'm saying?
yeah.
The thing about oil is, if you look on the grand scheme of things, it is. I don't want to say it's mean reverting, but I mean, oil goes all the way up to 140 right back in where was it all the way back in 2000, 147 in 2008, then all the way down to what -40, and it's like chopping in this range. So is it mean reverting? I don't want to say it is, but that's what the
It
futures
kind of is.
price. Yeah, that's what the futures are pricing in, right?
Yeah.
So, that's what this is backwardation, right? This is backwardation. Now let's see if we have what do the ES future term structures look like here? This is contango, right? Every month it goes higher and higher and higher. And realistically, it's just consensus, right? If something is going up a lot, the futures markets are going to be in backwardation, meaning they think that over time it'll go down. If, as stupid as that sounds, right? So market's been getting clobbered. So we're in a night. We have a nice solid backwardation. Contango curve going on here. Also, like by 2026, you think ES will be higher than today's price, right? That's what this is. ES today is 3899 spot 5. It's saying by what do you think it's going to be by December of 2026? Well, odds are it's going to be much higher, right?
You know what
4
I'm
years.
curious about? Just a
What?
random thought. I wonder what the forward curve was like during the crash in on Nasdaq
Oh,
in
and that
2000. So
if you
not
give
right
me a
now, but
sec,
in
no,
2000, I wonder
I'll get
if
you.
it predicted that it's going to take over a decade for Nasdaq to reach the highs again. Because
This is
I don't think
I
anyone
don't
back then
I
thought of
don't
that.
I don't know if I can see the immediate. No, I can't tell you I can tell you the short term spreads on the Nasdaq. Let's see what they did back then. Let's see. Will it bring me all the way back there? Yeah. So obviously you can see that these were all over the place, all the way down to -313. Actually, I think this made this all time low in 2001. Yeah. The front end, the difference between the front month and the following month was 313 points in December of 2000.
Jeez.
And to really put it into perspective, what that is, like, let's look what the Nasdaq was back then. The Nasdaq was only 2,400 points. So 313, right? It's like a 13% difference in 60 days.
Yeah, I mean, it wasn't far off.
Well, no, I'm saying the difference between the front month being we're going into December, so December's contract and March's contract was 300 points different. And yeah, it wasn't far off, and by as time went on, but as of December 2000, it was pricing in a 300 point difference. Isn't that crazy?
Yeah.
Right. That's I think that's insane. But as you can see over time, actually, you know what? Hold on. Let's see. So you have to be careful because some of these are contract rolls, like they roll out. Let's see. Can we get? Will it give me a 3? No, it won't give me 3 months out. Okay, no. Yeah, that's a con. Hold on. I don't want to misquote anyone here because that's actually now that I look at it, that's a contract roll. Hold on. Back in 2001, it's a contract roll. Let's see. Yeah. These spikes that you're seeing, um, let's see. This might be the end of the year, the end of the December contract roll here.
Hmm.
Long story short, 100 points. I wouldn't take this 313 number, -313 seriously, just because you're going into the end of the year. I believe this was the NQ contract roll. I would say that we had multiple days where it shot down here, and I mean it's a wide spread. I mean, let's go to today. What does today's spreads look like? We're pretty much peaking here. We're deep in the positives. As of COVID, COVID, we were all the way down -19. I think a good point here would be to put in a horizontal line at 0 and just give you an idea, right? Like you can see like what
Yeah. Wow.
complacency, right? This is the curve being so steep on the front end. And the shit kind of hits the fan when the curve's so complacent. Like the market was able to really like run so much because consensus was like not that the market didn't run here, but well, it did, right? Because see how consensus is not believing that the following month is going to be higher, and it kind of constantly is.
Yeah.
So
Yeah.
they
It's
kind of
funny.
get squeezed, right?
Consensus
So
is wrong.
look at this here, consensus, right? In 2009, they couldn't get front and back month positive switch until 2017. So for 8 years, basically, the market was going higher because no one thought it would. And then finally, when it does, it has this rip roar, right? It has this rip roar here, and consensus like kind of puts it into the sideways chop. See that? Like when they get too bullish.
Yeah.
Now look where we are. We're
Interesting.
back. We're back up here again.
Yeah.
Now I don't want to get off topic too much because the whole point of what we were talking about was VIX, right? And for those that have spent the 40 or so minutes here, 45 minutes here listening, we greatly appreciate it because we may get off topic every now and then. We may talk about things that you may think have no merit, but the reason why we talk about these things in depth is because we don't know who is coming to listen to what we're talking about, and we don't know where they are in their investment education or the cycle of their education, right? The path of their education. We don't know where they are. They could be newbies, rookies, right? Or they could be pros. We don't know. So we talk about these things in depth. We may bore some of the experienced individuals, but we hope that the the individuals that are inexperienced that are coming here, get the right introduction to the space, and they understand what we're talking about. So let's dive back into volatility and what this is. So as we just spoke about, this is basically the consensus spread where it is. Consensus is not scared. I'm gonna take VIX off, and we'll talk about it in a second. This is what scared consensus looks like, right? Like this is 2000, even 11. Forget 2000, 2009. I mean, I think 2009. Um, 2009, I believe, if we put on a candlestick, will be the low. Yeah, it is. This is the low. 2009 is the low in the front and back month VIX spreads. I don't. This is not what I'm telling you where I think we're going. What I'm saying we're gonna do. But as you can see, this is fear. Consensus is afraid in VIX, right? Um, and 2011, 2014. This is the flash. Oh, what's the flash crash here? This is the flash crash right here, right? Consensus gets scared just in the flat, which is only a couple of weeks, right?
Hmm. Yeah.
Um, and then this was going into the election,
But we
26.
haven't seen anything like that, like at the
Right.
very least, at least like down to -1. You know what I mean?
Yeah,
Like,
this was something on along the lines of, I think this was early 2018 was they thought Trump was going to get impeached. Remember that whole thing, and the market kind of took a shitter.
yeah, yeah.
Or it was either that or it was the China trade war, something along the lines. I'd have to like look it up exactly. I don't remember. Even then, capitulation, right? This is the Powell, the 2018 end of year Powell pump, or and the market like basically pulled him on it. Politically in the market and financially, the market basically reverted him. This is COVID. Obviously, this was the 2018 type of 2008, excuse me, type of event where it's just crisis. Now we're here. As you can see, we are not in any type of capitulation to the downside in equities, which is crazy because the market just keeps grinding lower every week. So it's just showing you the characteristics of the regime that we're in. The stagflation is so persistent in that it is literally chopping bulls and bears slowly lower. It is not washing people out. I don't care what anyone's saying to you on Twitter. There's no volatility washout. There's no capitulation. Let's look at VIX. I mean,
Well, there's
let's just,
no easy money essentially.
yeah,
It's like everyone
yeah,
that's like, oh, market's crashing, I'm going short. It's not going to work out. It's not going to be easy. You're not going to get the flush that you're looking for, and you're not going to get the rallies that you're looking for. It's very
right.
dangerous.
At least not yet. I mean, we can get a VIX pop and squeeze, and really this will blow. If VIX squeezes, as you can see here, when VIX has, you get these capitulations when VIX goes vertical. Like look here with this first move into this year, when VIX like went from 17 all the way up to 35, almost with one dip, the spreads kind of unloaded lower.
Yeah.
Now
So
we have this
that's
chop.
essentially what we need to see again, right?
Yeah, yeah, that's what I mean. That's every time in history. Like, we can scroll back in VIX. There's always a VIX blowout. And if you look at VIX right now, it looks like it's coiling,
Yeah, it
right?
really does. It's coiling to the
Yeah,
upside.
yeah, and we're basically long volatility. From like I believe it's the sub 22s or sub 24s on VIX. I believe it's like between it's like 22s on we're long vol at 22 VIX. For the anticipation of a blow off. Because we do believe that in a deflation regime, we're going to get a blow off, and until then, volatility will remain elevated. So we're, especially through, I think it's the midterm futures ETF that we're long. So obviously, it's bullish trend, right? It should go higher. We're long somewhere in this range, I believe. And we are expecting a blow off in VIX, which should push this higher. Now, I don't know when, but I can tell you with an elevated VIX, or a very strong, or very, um, yeah, very elevated VIX, that the volatility for us, our opinion is that the VIX midterm futures won't get too banged up. So if we have a prolonged period of stagflation going into deflation, well, we know in stagflation volatility is enhanced. So the VIX midterm futures ETF will hold up for us for our trading strategy. So we're holding that. Whereas you take something like VIXI, as you can see, let's take VIX up. You see how this is not really, it's chopping sideways, but all you need is a VIX to move lower, and this will actually print new lows. So
Yeah.
this is because this is short term. We want that midterm to get to get the broader allocation across the curve. So we don't get that straight backwardation effect. That's what this is, right? Where VIX futures just keep decaying and you're basically losing money forever, and you get these few pops every like. Look, we don't
Yeah.
want to own something that
Essentially,
looks
you
like that.
just
Yeah,
have way more risk on the
dilution. Yeah,
trade
yeah.
because we're not timing everything precisely. Like we know what's roughly going to happen, but like we don't have it timed to a T, so
Right. And
there's no
I
point
think
in playing
I
that.
think yeah, I think that's really what we want to pound the table on today is we don't know when the deflation like there's not an economic indicator or an economic release that I'm going to say that I could tell you today that I would say that would come out and be like, "Oh, that's a nail in the coffin, that's deflation," because that's not how it works. The market is a conglomerate pricing machine. If you read them, you have to learn to read the machine, not read what they're talking about on TV or Bloomberg headlines or any of that bullshit. You need to read what is happening today, right? What is coming out today? Those things conglomerately is what the market's pricing in. That's what the market's telling you. A conglomerate view on it, right? Of all these things that you may look at specifically, or headline releases, these specific releases are all conglomerately priced into the market. Now, the market will have to take all that information and pivot. We don't know when that's going to happen, but we're damn certain we're going to be paying attention to the time that it does. When that pivot happens, we will let you know. And once that happens, obviously, we're going to get positioned for that regime. We're not going to front run that regime immediately because stagflation is a very different beast. It is not like expansion inflation, right? These are very risk on, and risk on, everything's improving. Credit quality is improving. Volatility spreads are improving. Credit spreads are
You
improving.
just got
Um,
rainbows,
yeah,
flowers,
right. So
sunshine.
your long SPY in expansion or QQQ in expansion, it's going to ride all the way into inflation. So there's nothing really to be worried about, right? But a lot of things go south in deflation real quick. Like you go from some things being green on the year not performing to everything being red, and you're just in the thing that's down the most. That's how type of
And
180.
that's likely going to be commodities once we get to
Yeah,
deflation.
right, right, exactly. And that's something that why we're not long commodities right now. There doesn't make sense to be long commodities at this point in time because the gonging, the consequence of the gonging is so great that we don't want to be there and have to play safety on the way out. We'd rather miss the tail end of this move higher and say whatever than try and catch the rocket ship on the way up and then have to defend the falling knife. Um, But let's bring this in, and this is where we'll finish it up with finish up the podcast with lumber and housing. As we said earlier in the podcast, we can tell you that the consumer is weak. Obviously, deflation is going to exacerbate that problem of a weak consumer. The consumer is not strong, right? The consumer is weak, so deflation will just exacerbate that issue. Not so much as stagflation exacerbates the issue of the consumer and their debt, right? Because the cost of things will continue to stay high or go higher, and growth will be slowing. So they're going to be priced out of a lot of things. Where in deflation, everything comes down, right? So everything comes back to reality. Deflation is the roller coaster coming back to earth. The rocket ship coming back into the atmosphere. It's everything coming back to ground. That's what deflation is. And home prices, right? Those coming down as well. We we get a lagging indicator from it's the last reading was all the way out in February. It's February's data, so we'll have March's data soon, but we're already in May, right? So in a few more weeks we'll be in June. This is kind of useless, this year-over-year housing data. If you just
That's
look,
so delayed.
yeah, if you just look at lumber, if we take this off and make this not so confusing, if you just look at lumber, you'll notice that when lumber bottoms and rises, usually the housing market has done that too, has done that as well. Rising lumber prices usually mean the housing market, you know, goes higher or sustains, right? Falling lumber prices are very bad for housing. Um, peak lumber, peak housing type of mentality. We don't see lumber going any higher because of growth slowing. So obviously, we think housing's coming down. We've been saying this for a while now. We think everything's coming down. Now, this is going to be a problem for those that are leveraged out in their homes. So if you have a mortgage, maybe say you paid off 50%, right, or 60% of your mortgage, and you have a HELOC, right? And the price, and you got the mortgage and the HELOC within the last year and a half, 2 years, to quote unquote leverage out your. That's the thing. Apparently, is people like to leverage out their homes and do dumb shit with it. But long story short, if the home prices keep going down, you're getting into it now. It's nowhere near as 2000 as bad as 2008, but you start getting to a point where you're looking at this HELOC and these payments, and you're paying for something that's no longer worth what you paid for it. Not that it's down like 2008 where it's down 50 to depending where 60%, whatever, crazy declines that were seen across specific counties in the country. It's most likely not going to happen in that manner, but you're going to get people that are leveraged out and paying, barely getting by, thinking that their use of this leverage, maybe, listen, they saw the market's hitting all-time highs, maybe they took out a HELOC and put it in the market, right? So the market's going down, so their money's basically eviscerating in the loan that they took out. That's going down in value, and the home price of which they took the loan out against is going down in value. So they start thinking like, well, I'm going to be paying monthly interest payments or principal combined payments on something that's no longer worth what I thought it was worth. And this is the problem. Housing, by a lot of people consider housing to be basically like the housing is the world's biggest market because there's more houses than there are, right? There's more value in homes than there is anything in anywhere else across the entire globe. So people look at housing as the safest place to be because everyone needs a house. So they get overly cocky with housing. They think nothing bad can happen, right? Now, to an extent, they're right. Not 2008 can happen again. I don't think so. Long story short, yeah, housing prices can go down, but is it going to really like be a crisis? Probably not. But you're having people that may have bought a home and he locked it out and took that money and tried to buy another home. They may own 3 homes that they are getting by just with mortgage payments right now. All it takes is, issues for renters not to pay rent and home prices to go down, and they realize, oh shit, I made a mistake.
Yeah, and
And
that's just kind of another piece of the pie, adding to the weaker consumer.
right, right.
It's just kind
Eventually,
of
you'll have
everything
yeah,
together.
yeah. Eventually, you'll have those folks um, that are in apartments they can't afford, and like it's not going to be like 2008 because we've gotten a much more I should say credit aware with who we're giving loans out to. But you know, even then, you still got the people that skate by, unfortunately, and like they do these things because they think times are always good, and that's not the case. There's always going to be some bad times. It's about making sure that when those bad times happen, you're there to prepare. You're prepared and there to take advantage of them, which is why our regime cycle is so important. Because if you're in mostly cash going into deflation, when you get into expansion, you can load the. Or it depends. If we get a deflation pivot, we have a large portion of cash. We can load the lows and hammer the lows in TMF. And if we miss the TMF trade, would we hate ourselves? Yeah. Would we hate the situation? We'd be upset, right? We'd be like, oh, whatever. Like, let's just say TMF goes vertical right now. But at the end of the day, we don't believe it will. And even if it does, we don't really care because the cycle is so great across the entire curve, or the money to be made is so great across the entire curve that it doesn't really matter if you miss one thing here or one thing there. It's about constantly being in the game. So riding the waves up and handling the waves down over time, over years, is how you can compound with proper use of leverage. You can compound ridiculous returns, which is what we intend to show you in the public account. We can, do that personally, but no one really wants to see, where we are today. You guys want to see where you guys, you want to show you where you could be if you were to publicly follow everything that we say. If we were to show you where we are today, well, it would be very hard to show you that, given that those statements weren't made publicly. And we want to make sure that everything we show you is backed up with live calls and live input from us. So we can basically show you that it is repeatable. Like, we didn't just get lucky. That's what we're trying. That's the whole purpose of the public account.
Yeah.
But I think that we covered a lot of things. And if you have anything else to add?
No, I think that was good. I think, sorry if we were all over the place, but there's a lot of things, a lot of moving parts to this regime shift, and so we're here to help guide everyone through. And thanks for listening.
Yep. And if you have any questions, feel free to reach out to us in our Discord. All the information can be found at www.market-radar.com. You can find our system posted for free, the ability to get DDAP on your own TradingView account, so you can see all the stuff that we see in real time, and as well the link to the Discord, so you can come and chat and ask questions to us on a personal level, or just for us to help you clarify the things that you may not understand. And other than that, thank you so much for listening. Have a great week, and we'll see you on Twitter.